Let's get more from Jerry Lowe, Morgan Stanley's China strategist. In fact, Jerry is among the top-ranked analysts for Chinese stocks by Institutional Investor magazine, and he joins us from Singapore this morning. Jerry, what's going on here? I guess people are thinking what kind of coffee you're drinking, but is this about picking off the bottom?
Yeah, I think, there are several reasons. I think technically the market looks very, very oversold. Shanghai is now trading even at a discount to their counterparts in Hong Kong. This is really, really rare in the past 2 decades. If you look at the historical chart, you've seen that in 2004. You've seen that very, very briefly in 2008. And each time when it drifts below that level, it rebounds more than 50% in the coming 12 months. So that's why I'm saying, from a technical perspective, I think this is a pretty safe call. A lot of people think I'm crazy. From a fundamental perspective, as you said, it's trading at a decade lowest valuation point, which is very, very rare for the Asian market. Remember, it is a market with a fundamental premium factor there, which is a capital account control, which is the lack of security assets in the country. So by default, Shanghai should be trading at, I think, 20 to 30% premium to their Hong Kong counterparts, and now it's trading at discount. So technically very oversold, fundamentally still robust, and valuation-wise looks very, very attractive. And that's why we think we should be overweighting all the deep cyclicals, including the banks, material, energy, properties. So basically, we're really a full house overweight on China. And we think we were cautious in the market. We were underweighting the deep cyclicals, but this is the point where we really look at the fundamentals, have faith in the fundamentals rather than betting what the next market catalyst is. I tell you, if you knew what the market catalyst will be, the market wouldn't be trading at such cheap levels. So we're really counting on that, and coming 12 months, we are looking at a pretty major rally in Shanghai. We don't think the Asian investors are seeing something so terrible and that the foreign investors are not seeing. I think it's just a very, very sentimental market and technically overstretched.
Okay, now, Jerry, you talked about catalysts. Some people look at what happened on June 19th when China said we might reform the currency regime, depegging it from the U.S. dollar. That might be something that's moving markets and stocks in the future.
I think so. I think China seems to be separating in 2 steps. They're depegging first, and then they allow the crawling appreciation to happen again. We think we need a little bit more time to build a track, right? You can't convince the market that the RMB on the track of appreciating by a mid-single-digit annualized rate just after a few days or a few weeks. So I think if you give it a month or 2, if that momentum is really being built up, it's going to attract a lot of liquidity back into the market, and that's going to be particularly good for the banks and properties.
Okay, now, Jerry, you talked about banks, you talked about property and the deep cyclicals, as you mentioned before, basically the shares in the sectors that people don't like. Let me just get more on the banking sector in particular, because, we have Agricultural Bank of China dropping shares, making that huge debut later on this month. In fact, it could be a history-setting IPO here. Do you think that might drag and suck up some liquidity from the markets and from other banking shares as well?
Well, I think, we shouldn't just look at from a liquidity balance angle in the market. Well, it seems like the market is very focused on this, right? But if you look at the overall history of the A-share market, actually the liquidity volatility, if really creating any negative shock to the market, every time is a great time to buy. If you think about when was the period that China raised the majority amount of equities, in the market, that was 2005, and guess the performance in that year. It was a huge rally year, actually, rather than most people predicted being a very bearish year. So I would actually think, we should look through this temporary liquidity imbalances and really focus on, the fundamental strengths of the economy, the fundamental strengths of the currency, and the fundamental strengths of the technicals. I think that's what we should be focused on.
Okay, Jerry, thank you for joining us this morning. Nice talking to you. Have a great weekend. That's Jerry.